Okay, good afternoon and welcome back everyone to our small exchange futures trading series. Today we're here to talk about trading interest rates using small futures. And I have a very special guest here, Frank Kaberna from the small exchange to join me and talk a little bit about interest rate trading future strategies from a former CBOT trader. Frank, first of all, thank you so much for joining us today.
Tony, thanks so much for having me, man. This is going to be a blast. We're going to learn a lot, cover a lot of ground. Yeah, a little background about myself. I started out of college trading at the Chicago Board of Trade, prop trading for a group there for a little over a year. I was trading the Asian and European markets and got to know interest rates very, very well. Treasury futures, Treasury cash, Eurodollar futures, and everything else, as you could imagine, in that wide world of interest rates, spread trading, so much fun stuff in there. Today, though, we're going to talk about the small exchange and what they've brought to the everyday trader in the way of interest rates, which is a way simpler playground to be playing on here in 2021. A lot easier than it was for me back in 2015, but a lot of fun stuff here, Tony. I don't want to get too ahead of myself, but thanks so much for having me, man.
Well, thank you so much for being here, and I'm going to echo that. We talk a lot about interest rates as equity traders. We talk about it from a valuations perspective, from a fundamental perspective. We also talk about it from an intraday perspective. So today, I'm really excited to share with a lot of investors because I've even learned quite a bit since these products have been launched, the ability to trade these interest rates short term, because there really hasn't been a product for retail investors to trade interest rates short term until these products were listed. So I'm really excited to share many of those things that I've learned with the audience here today. So really looking forward to get started with that. But before we get started, what we're going to discuss today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today what we'll do is we'll do a very quick intro to small futures contracts. We'll talk a little bit about the ethos behind the small exchange, what you guys are trying to build. We'll talk a little bit about that before we jump into interest rate futures, specifically the type of products that are available to trade interest rates. We'll talk a little bit about the existing futures contracts that are available, the types of products that equity traders currently use, and there's a pretty wide gamut in terms of what equity traders will use to trade interest rates with. And then we'll talk a little bit about the small futures and how that really truly has revolutionized the way that a retail trader or any trader can have access to the interest rates, not only long-term, but also short-term. So we'll talk about both short-term trading strategies, which, as I said, was not really accessible for retail traders before the small exchange products, right? So I've learned new strategies on this, and we're going to talk about those today, whether you're trading the interest rate outright or the spread between two interest rates. And then we'll also talk a little bit about longer term interest rate strategies, which I would say for many equity investors, this is something that they're more familiar with, trading TLT, trading some of the bond ETFs, taking a longer term view. And then we'll try to go through as many trade examples as possible before we open this up for Q&A. But before we jump into that, Frank, you gave a quick overview, but I just want to give you a chance to talk a little bit about, your background, because interest rates is really one of those products that I think for most investors is this very foreign thing, right? We kind of have an idea of what interest rates are, but we usually don't trade those interest rates. So if you don't mind talking a little bit about, what you were trading when you were on the Chicago Board of Trade with respect to interest rates, because I think that'll help, frame how investors could potentially learn from this session here today.
Yeah, absolutely. I mean, man, I got real deep on interest rates when I was at the Board of Trade, and it was a lot of fun coming from my math degree at University of Michigan. It was a lot of flexing those muscles to learn about trading stuff like, I don't know if anybody here has heard about like the knob spread, one of the most popular pairs trades or spreads out there in the world of futures. But to do stuff like that, you had to crunch all these numbers based in like dollar value of a basis point, DVO1. And I'm throwing out all these terms, Tony, not to scare anybody off, but to honestly walk through the barriers to entry that the small exchange has knocked down in the last 6 months since it's launched this suite of interest rate products. Like, I quite literally needed that math degree, and then also needed several months of just every single day. My job was getting myself on board with how to trade interest rates, all the way from the theoretical idea of just like, this is a percentage that affects so many things in the economy, to trading basis between 10-year cash treasuries and 10-year futures. Like, and that was a long journey. And I mean, I don't need to go any deeper than that. I think that that's plenty there, because I don't want people to have to do all of that work, because I talk about that journey from reading about or learning about interest rates, reading about what the Fed is doing, how that could affect technology companies or financial companies, all these different inner workings of the economy. What we did here at the small exchange is make that journey as short as possible, so you could have a portfolio of long stocks, or you could just be an active trader who is flat at the start of the day and looking to day trade some stuff and take your opinion on interest rates, take your research or your technical analysis, whatever it is, to an interest rate strategy as quick as possible. We'll show you how we did it, and we'll show you how that stacks up to traditional products that, like I said, like it took me months to figure out how these traditional futures trade, how they trade against each other, all the ratios and DVO1s and different coupon payments and all of that stuff that, in my mind, as someone who's walked through all of it, Tony, is non-essential to actually formulating a theory and an idea in interest rates and bringing it to action.
Right. And that's exactly, I think, from my perspective, what really caught my attention when we started having the conversation around the small exchange. We actually started this conversation almost a year ago. And for me, when you guys first talked to me about this new futures exchange, I actually thought you guys were a little crazy trying to compete with CME. Trying to launch a new futures exchange. But then when I learned about, what you guys were doing, the small, standard, simple approach to futures trading, it really changed my mind, because I actually started my career in derivatives on futures, trading futures, trading mostly day trading futures in the E-mini complex. Tried to get into some of the other futures like oil, gold, some of the softs, and really found the learning curve almost too difficult, if you will, to step into some of those products. And I never ever touched interest rates, just because it was the learning curve was just simply way too heavy, if you will. And then I learned about the interest rate products that you guys launched, and it really changed my mind in terms of what retail investors should have access to, because we talk about interest rates, right? As equity investors, we talk about the 10-year yield almost on a daily basis, yet there wasn't a way to trade that 10-year yield. We had a view on the 10-year yield, but we couldn't trade it. And we kind of figured out ways, alternative ways, and we're going to talk about some of those alternative ways here today. But that's really what changed my mind as far as why I think this is a product that retail traders really should look at. So before we jump into it, I do want to give you just a minute to talk a little bit about the small standard ethos that the small exchange has, and the product ranges that you guys are trying to create, including a new product that you guys just listed this week.
Yeah, absolutely. I mean, and you nailed it there in a string of beautiful words, Tony. But one of the most beautiful ones that you use there is access. Like, our goal from the small exchange is absolutely to innovate. We want to bring new markets in here, and we're looking to add some new markets throughout the summer that you'll see that don't currently exist in the futures world. So get excited for that. You might see something like a cannabis product or different innovative markets down the line. But our real purpose here, Tony, was to create greater access to the everyday trader. And that was something that was essential to us coming out of the gate. Wasn't to create a whole new stock market or a new energy market or a new form of cryptocurrency, something that maybe is more buzzwordy and more sexy. But at the end of the day, it comes and goes with different trends. What we wanted to do was say, hey, look at this market interest rates that's referenced all the time, but people just don't know how to access it, or it doesn't come in the right size, or it doesn't look clear enough for them to know what the hell to do with it. I mean, my job on a lot of networks between my time at the Board of Trade and when the small exchange launched last year was simply to teach people how to go from their opinion on interest rates to actually trading it. And that was a lot of work, like it was so much work to be like, you think interest rates are going to move higher. You can go to TLT or bond futures, but you actually have to sell it if you think they're going higher. Oh, are bond futures too big? Then I guess you could sell a call spread. Like, it was too much, man. So what we did in interest rates and also stock markets and foreign exchange and metals, and just this week, crude oil, was essentially say, let's get these people a product that looks like stocks and ETFs. It takes in a penny and it trades. Each of those penny is $1. They're just like 100 shares, or those of you who are trading options on stocks and ETFs. And let's make sure that that size of each of those products is something that most people can feel comfortable with, because that's a huge point of traditional futures that like interest rate futures exist. You know this. Equity, you just referenced the E-mini S&P, that exists. Crude oil futures exist, all that stuff, but they're moving. Yesterday, a great example, moving thousands of dollars on a daily basis. If you're trying to day trade or you're trying to use that as an investment vehicle, a lot of those markets are simply too big. So we paired a lot of that simplicity of the way stocks look with a smaller size, and then threw on top the efficiency of futures. Because then that begs the question, well, why didn't you just create ETFs that tracked the interest rate and made it simpler that way? Well, different markets like interest rates and like foreign exchange are traditionally lower volatility. And so if you're paying 50% or 100% to long those markets, that quickly becomes very expensive for something that maybe doesn't move as much. With the efficiency of futures, your capital requirements sit anywhere between our US dollar product. You have to post just barely over 1% to trade that product, because currencies don't move as much as stocks and commodities. And that ranges to stocks and those commodity markets that require a bit more, but still much less than 50%, which is the lowest side of buying shares of an ETF. So a lot of good stuff here baked into the full suite of small exchange products, but the main tenets there are small so that anyone can feel comfortable joining these markets and not lose sleep over, oh man, I've got a long crude oil position. I don't know anybody who can sleep well with a long crude oil position in the traditional futures. Standard, everything ticks in a penny, looks like $1, as simple as it gets, just like 100 shares of stock. And then each of these products, like we're about to dig into with interest rates in mind, simple, man, like it's as clear as you would imagine it when you're reading an article in your favorite news outlet. Like, so many times, and this is what we got frustrated with, like people reading about yields. It's quoted on the Wall Street Journal. It's quoted on all these different news sites and these different media platforms, but no one's trading it because no one can get a handle on the products. And so all of that is baked in here to the small exchange futures. They are futures. They look like stock, and they're simple, like the stuff you read in the news.
Right. So I thank you so much for that explanation. I think that's exactly what we're trying to show here today, is really the small exchange futures captures the benefit of options and stocks and futures into one product that I think many retail investors can trade. So, and I always think that the best way to actually learn this is to go through some examples. That's exactly what we're going to go through here today. So if you have any questions regarding small exchange products, futures, anything that we're going to talk about in terms of interest rates or the strategies we're going to talk about, the small exchange has graciously brought on some people, Michael, who's going to be answering questions in the Q&A section. So as we go along, if you have questions, please type your questions into the Q&A window, and then we will have someone on the small exchange answer your questions live as Frank and I go through the examples here today. So let's first just talk a little bit about interest rates before we get into trading them. So interest rates are simply just an expression of the payments, if you will, of a bond versus the bond price itself. And many of us are familiar with something similar to this in terms of in the form of a dividend yield, the amount of dividends you get paid for the holding of the amount of dividends you get paid for the year with respect to the stock price. The interest rate is similar to that for a bond. It tells you the amount that you're paid versus the bond price. And this is not necessarily new for most investors because, as you say, Frank, almost everyone here who's an investor has seen the interest rates that are quoted. The only thing we should be clear on is that when we refer to interest rates in the context of this session, we're talking about interest rates on US government bonds, sure, as opposed to interest rates on corporate bonds or muni bonds or any other type of bonds. So we're referring to treasury bonds here. And the reality is that the interest rate itself is not traded. What's traded are actually the bonds themselves. And while we do talk about the fluctuation of bond prices, it's far more common that we quote the changes in the bond prices in yield terms rather than bond price terms. And all we're trying to do here is express a view on whether interest rates will rise or fall. And the question becomes, how do you express that view? And that's been historically the challenge that we have faced as investors.
Yeah, absolutely. Like, nailed it there. Great context. And just first off the bat, why US Treasuries? That's the benchmark. Like, there are interest rates baked into so many different bond products, corporate and otherwise. But when you see something in the news or you want that exposure in like the broad benchmark market, like this, the same way that anybody who is new to investing, almost always the first thing that someone tells them is like, yeah, just like get some form of exposure to the S&P 500. Like, that is the place to start. And from there you can get, you know, more particular or just stay that broad. It's the same way in interest rates. The 10-year yield is almost always the thing you're going to see quoted, unless you're reading a story or talking about the Fed. They're talking about Fed funds rates, which is just a short-term version of that. But it's almost always US Treasury debt here that we're talking about. And that's exactly right, that like TLT and ZB futures, ZN futures, all these different variants that most people, until the small exchange came along, are used to trading in the interest rate space. They do trade in bond price, because that is on the cash side, like the actual market, akin to like crude oil futures, actual barrels of crude oil. It is the same situation where it's like bond futures and the bond prices of them themselves. They don't trade in interest rates, but no one knows the bond prices, right, Tony? Like, when you're talking about this stuff and you're researching it and you're getting ready to trade it, I myself, as someone who is, you know, pretty well experienced in the interest rate space, I could tell you right off the bat where the 10-year yield is, but I can't tell you what the 10-year cash treasury price is. Like, nobody thinks like that. Nobody on the retail side is researching like that. And so, yeah, you'll see here the growth from the futures to ETFs to small futures, that's really where things are taking a turn here in 2021, is getting away from the bond price into the yield itself.
Yeah, and one thing I will add to that, you know, there is one thing that options traders are probably familiar with that are similar to this, which is the VIX and the relationship between the VIX and the S&P 500, yep. Right? We quote the VIX, but the VIX itself is not actually tradable. It's actually just an expression of the implied volatility of the 30-day SPX options. And they have an inverse relationship. As the SPX goes up, VIX goes down, vice versa. So you have a very similar, I would say, dynamic here between the VIX and SPX as you do with interest rates and bond prices. So that's just another way to think about these kind of things that we talk about in the markets that we quote, but we can't actually trade themselves. So when it comes to expressing an interest rate view, there are quite a few different ways that you can do that, right? You had talked about your former career, which was in CBOT futures. These are where you trade the treasury futures, the cash treasury, either the cash or the treasury futures. And these have, number one, fairly large notional value sizes, not really suitable for retail. As you said, the learning curve is extremely difficult and extremely steep to understand the products themselves, and they trade in very odd pricing. Right, it's one of the few products that are still trading in 30 seconds as opposed to decimals. It's really back. We're talking about like the 80s and 90s in terms of the stock prices when they're still quoted in 30 seconds. So still kind of stuck a little bit in the past on that front. So I don't know if we want to spend too much time on it, but I think it's clear for most investors that that's not the best product for a retail trader to trade. It's really more of an institutional product.
No, absolutely. Yeah, you can tell. I mean, it takes 5 seconds. Once you see the way it's quoted, you're like, oh, this thing isn't for me. Like it just
Right.
went from 100 slash 31 to 132 to 101. Like, where the hell did that come from? Like it's out of 30 seconds. The notional is really large. All of the futures in US Treasuries are above $100 currently. So big notional sizes. You've got actually a 2-year treasury that is over $200,000 in notional value currently. Like, even if the thing moves slow, that is way too much exposure per one unit that I could ever think of. And yeah, I think a lot of people were probably like, man, why the hell is this guy talking about the standardization of a penny tick? Like, most things tick in pennies. Treasuries don't. Like it was honestly a big thing for us to just even get that far, to get something that looks like your ETFs and stocks and everything else. But yeah, on the next note here, you've got some ETFs that they got closer, Tony, but didn't quite get there.
Yeah, and for those of you that have followed me for a while, and we do this all the time, right? We express a view on interest rates on CNBC, on options action, and you should see the gamut of symbols that we have used to express either a decline, a rise in interest rates or decline in interest rates. Everything from TLT to to UUP, the dollar ETF, to a commodity sensitive stocks like FCX, miners.
Sure.
There's just a very, very wide variety of either bond ETFs or proxies that you can use, all of which give you some exposure to interest rates, but it's never a perfect correlation to the interest rate expression that you're really looking for. And that's really it's good from that perspective, but also many of them have a relatively lower correlation to interest rates, but they also still have the same problem where you have to trade the inverse, right? If you think interest rates are going to go higher, TLT is arguably a pretty good product for that, but you have to short TLT. And if you don't have a margin account, you can't short TLT. If you don't want to buy puts, or puts are too expensive, you may not be able to express your views that interest rates are going to go higher. And contract sizes are all over the place. TLT is a higher priced dollar amount. There are other ETFs that are lower price. Stocks are obviously all different price. So you kind of have a very mixed bag of what you can trade, and it's not particularly, in my opinion, a strong correlation to interest rates at the end of the day.
No, sorry. Yeah, it's like essentially someone created like cereal for the first time, and they were like, here is a million cereals that aren't exactly the straightforward like cornflakes that you wanted. It's like, man, like there's TLT, there's an inverse TLT, Tony, which literally moves up and down with yields, but it's priced at I think like $25, which doesn't coordinate with like the actual interest rates. So the big thing for us was like, man, these ETFs are getting close. They're getting so close, but why don't they make something that just looks like the interest rate that people are reading about in the news? Because like, you could tell me that, okay, I want to make a position on interest rates moving higher in the future. And okay, well, you have to go sell TLT shares or sell calls in there or buy puts. But still, I'm uncomfortable because like, at what point do I own interest rates? Like, do I own them at 1.5%? Do I own them at 1.6? Like, why is there still this lack of clarity between where I'm investing and like what I'm trying to get done in the future? And we just said, enough of it, man. Like, we're going to create 3 futures products off the bat. They're going to tick in pennies that equate to $1, just like 100 shares of stock. But when you trade the 2-year small exchange future, it's rising and falling tick for tick with basis points in that US 2-year treasury rate. Same with the 10-year, same with the 30-year. There's no like opaqueness or anything that is keeping you unclear on where your investment or trading dollars are going.
Exactly. So that's what brings us to the small futures contracts. And this is really what, for me, felt the most innovative product that kind of gravitated for me towards the small exchange was these interest rate futures, because we never had a good way to trade interest rates themselves. This was really the product that I felt, sealed the deal for me. It's size for retail. You can trade the interest rates directly. It's like being able to trade the VIX directly, right? Being able to trade exactly where you thought the VIX was going to go, exactly where you think the interest rate itself is going to go, and it ticks in pennies or in in dollar ticks for every contract, which is, you can think of it as owning 100 shares of an ETF. So each dollar in terms of a tick is going to equate to 1/10 of a basis point move in that underlying interest rate. So you can know exactly how much money you can potentially make or lose if the interest rate hits your target or hits your stop loss. Wherever you think interest rates are going to go, you can calculate exactly what your P&L is. Because if I shorted TLT and I thought interest rates are going to go from 170 basis points to 200 basis points, I couldn't quite tell you how much profit I would get from shorting TLT. But when I buy a small interest, a 10-year future, if it goes from 170 to 200, I know exactly how much money I can potentially make on that trade. And if it went down to 150, exactly in dollar amounts, how much I can lose. And currently you can trade the 2, 10, and 30-year rates. And what's one particularly interesting thing, and we'll talk a little bit about this when we talk about trading spreads, is that you can actually trade the spread between interest rates, a steepener or a flattener, on a one-to-one basis, because you're trading the interest rates themselves. And that was actually something I didn't realize until even just a couple of months ago, because I still thought in my head that if you wanted to trade the spread, and this is something you can talk about when you're trading the full futures, you have to figure out the right notional amounts on each contract to trade the spread. Here, you can just trade one for one and know that you're trading the spread directly.
That's absolutely right. Yeah, I don't want to go too deep on spreads, but that's a huge point that I'm sure once we get people comfortable with, that I always go to the S10Y at first, because that 10-year is truly the benchmark for rates. You see it the most places. And from my trading experience, when you're talking about non-farm payrolls, or even those Fed announcements where they're shifting around the Fed funds rates, none of these, 2, 10, or 30-year yields are necessarily being moved directly by the Federal Reserve, but it's always the 10-year that moves the fastest and moves the first. It is that S&P 500 of interest rates. But yeah, it is a nice, real nice piece. Once you get comfortable with like, oh, if I think interest rates are moving higher, then I buy it. If I think they're going lower, I sell it. And I can see that, at $17 in S10Y, that's 1.7%. Once you get comfortable there, yeah, the ability to spread these things off against each other one for one is something that I would have loved to have at the Board of Trade, because those ratios moved all the time. I traded 3-to-1 knob spreads. I traded 3-to-2 knob spreads. I traded 5-to-1 fights, which is 5 versus 10s. Everything was constantly moving, ratios changing. But when you're trading in yield, everything is on that same level playing field. So easy to spread against each other. But I'm getting too far afield, Tony. I'm sorry.
No, it's okay. So, and there's more products than just the interest rate products. We're not going to talk too much about the index, the equity index products. We're not going to talk much about the small dollar index or the precious metals index. We're going to predominantly focus our attention on the 2, 10, and 30-year products that allows you to trade the 2-year interest rate, the 10-year, and the 30-year interest rate directly. And if we have time, we'll talk a little bit about the new product that recently just launched here on crude oil. So let's first talk about a short-term trading strategy. So this is getting into, now that you know that you can access the 2, 10, and 20 and 30 year. And I just want to answer one question that I think is worth talking about, because there were a couple of questions in the queue about where can you trade small futures today. Currently, my understanding is that you can trade them at Tastyworks and you can trade them at Interactive Brokers. Those are the two brokerage firms that you currently can trade these products today.
Yeah, there's a few others there. We're currently onboarding at several other firms as well. Thankfully, that is not. I'm the ideas guy, Tony. Like I get to jump on with people like you and help create products, but our team is hard at work onboarding them at a bunch of different places here. But we're seeing most of our action predominantly coming out of Interactive Brokers, Tastyworks. We're currently lined up to do a couple other things with some StoneX firms as well. So we're growing, but yeah, that's predominantly where it's coming from. Great call out there. I'm glad that we got to touch that.
Right. So let's talk a little bit about a short-term trading strategy. Now, this is actually a strategy I've recently learned from you because, as a futures trader, I was a very active futures trader in E-minis. But when we talk about yields, at least for most equity investors, we don't think of yields as an active trading product. And largely, I would say that comes down to the fact that we didn't really have access to a product that allowed us to trade interest rates actively. Sure. But it seems like this is actually many of the trades that you did in your career at the Chicago Board of Trade in terms of interest rate futures were short-term strategies. So I'd love for you to talk a little bit about, what is the fundamental strategy behind these short-dated or intraday trades, if you will, that you would make on the exchange.
Sure. Yeah. I'd love to lift the curtain here a little bit. I feel like the statute of limitations on like what I can and can't say that I learned from the prop shop is far past. And actually, they have since consolidated with a different firm. So like, there are too many degrees of separation. They ain't going to catch me for what we're going to talk about here. But what the idea was like mean reversion in interest rates is it holds so much better than any other asset class. And we've been seeing it for decades. Now, what do I mean by mean reversion? If you look at the S&P 500, you're going to see that depending on what decade in the past you're looking at, that thing was priced in the hundreds to then in the, the aughts and the 2010s in the, 1,000 to 2,000. And now it's at 4,000. There's no mean reversion there. Like it drifts positive. And so if you're just selling every new high in the S&P 500, you've lost a lot of money over the years. Now, in interest rates, we have a really intriguing market similar to the VIX. I'm liking that we keep coming back here because it is similar to the VIX where it's like in the last 3 decades, you've got a 10-year interest rate that ranges anywhere from got to about 0.5 percentage point last year. Actually, the low going back to the 90s and beyond was just last year at 0.5 percentage point in the 10-year. It's gotten as high as 700, 800 basis points, 7 or 8%. But historically, it tends to live in the middle there. Similar on a short-term basis, you see these mean reverting qualities in interest rates where of course, it's going to trend somewhere in the medium term where it's like in 2021, for instance, it has been an environment where interest rates have moved higher. Like we've seen this 10-year go from about 1% to 1.7%. But on an intraday basis, you see a lot of 5, 6 basis point moves to the upside, and then it comes back a little bit. And this is what we were doing intraday. I was doing it actually not intraday here if you're living in the US. I was doing this at night and early morning during Asian and European market hours. But no matter what the session was, it was a matter of like 10 years are up a lot. Now I'm going to sell into them because they do tend to mean revert and hope that they come back a little bit. 10 years are down a bunch. I'm going to buy a couple and look at a mean reversion to the upside. And what we have here, and we do this for all of our subscribers, people who are part of the small exchange community, and now we've got the numbers here free for all of the viewers out there, is the standard deviation for each of these interest rates. And zeroing in on the 10-year here, we've got about 45 cents plus or minus on a given day. Now, what that means is that the S10Y product or the 10-year yield product tends to live in a range on a given day of 45 cents up or 45 cents down. But when we get to those boundary levels, when it gets up to yesterday, 10-year rates up, 50, 60 cents at one point, and then came back a little bit. And actually today, mean reverted all the way to where they were before yesterday. But either way, you are banking on these markets coming back to their normal environment. Now, do we see certain days where that 10-year product is going to be up 80 cents or 90 cents and stay out there? Yes, but that is the outlier move. That is the abnormal there. And so what we would do at the prop trading firm would be like, all right, S10Y, if we had this beautiful product at our disposal, S10Y is up 50 cents. I'm going to sell one. Oh, it's up 60 cents. I'm going to sell another one. And if it comes back to being up only 40 or 30 cents, then I'm taking my profits there for an intraday scalp, as is the term in the industry. Now, if it goes up and it settles at 70 cents or 80 cents, then I take my losses there. But these one standard deviations, those math theoreticians out there know that that's a 68% likelihood that the market stays within those boundaries. So you do have that edge on your side of this market reverting back into its standard deviation 68% of the time. But of course, the market does settle outside there 32% of the time. We also have the numbers for the 2 and 3 standard deviations. One standard deviation, 68%, 2 standard deviations, 95%, 3 of them, 99%. That only occurs less than 1% of the time that we get outside of $1.35 in the S10Y. But a lot of numbers there, a lot to digest. But at the end of the day, it's a similar mean reverting policy as like the stock market crashes lower, VIX gets up to 40 or gets up to 50. At some point in the near future, that VIX usually comes down to where it normally lives, around 15 to 20. Same here in interest rates across all 3 products.
Right. So this is fantastic. So just to be clear, right, what we're saying here is that just so we summarize, interest rates are mean reverting. It's one of the few products that truly are mean reverting, meaning when you have outsized moves in the underlying interest rate themselves, they tend to come back towards the average or this middle that we're referring to. And one of the things that we can do is we can use the historical standard deviation to determine what that range is. And for the 10 year, it's about effectively 4.5 basis points, because each tick is a tenth of a basis point. So 45 ticks would be equivalent of 4.5 basis points. If you're trading the 30 year, that's about 4.1 basis points, and the 10 year is about 1.2 basis points. So whenever you see any of these products move outside of these ranges, if it's a big rally, you're going to sell it. If it's a big decline, you're going to buy it. Correct?
That's exactly what we're looking at here. That is the mean reversion trade. Yeah, in a market that has a lot more mean reverting tendencies than equities and everything else. And yeah, I love that you bring this up, because this is right now sitting on the precipice of that outside day, but still in my mind, an intriguing one to look at, given that the 10-year is down exactly its 1 standard deviation, 45 cents.
Yeah. So I think the best way to learn is to look at some examples, right? So as I bring up the S10Y, which is the 10-year yield, it's currently down effectively 4.4 basis points on the day. So right, as you said, on the edge. Now we're not far from the close. So technically we'd look for this type of move earlier in the day, but we did have that move earlier in the day when it got as low as 1642 or so on the low. You would basically effectively try to buy SY10 on this sizable move to the downside. And yesterday, as you said, big move here to the upside, you would have faded that move because you had the inverse move yesterday. It was a big rally, and we're looking to short the SY10.
Yeah, absolutely. And what's really nice about this is these are like, time is continuous, and I'm not going to put on like my my Matthew McConaughey hat here and do like a whole True Detective thing, but like, you can absolutely, in the same way that yesterday we saw a big rally in interest rates, today it's reverting back lower. Though there's only an hour or so left in the day, you can see that like, we're looking for mean reversion trades just in the next few hours of trading, no matter where you are. Like, these markets are in theory moving all the time. So 45 cents lower here today, you could still look at buying that market and looking for a reversion in the next, by the end of the week, which would be Friday's close, there is a lot of opportunity here. As long as, like we talk about short term, it doesn't have to necessarily be like the US session here. It can be just like, I don't want to live with this trade for like the next couple of days to weeks. That's more of the long-term strategies that we'll get to in a second. But yeah, great example here. Yesterday, big rally higher of about, like I said, like 60 cents, 70 cents, came all the way back in the next 24 hours of trading. Now we're dealing with a big move to the downside here of that full 1 standard deviation. Could look for some reversion to the upside. This is exactly what we did at the prop shop.
So perfect. So I think we've nailed I think we're clear as to what is the criteria for entry, right? If you have a sizable move to the downside above, beyond the 1 standard deviation, you look at going long. If it's a sizable move above that 1 standard deviation, you look to go short. Let's talk a little bit about how far you would expect this to move. Where would you set your stop losses? Where would you take profits?
Yeah, absolutely. And it only makes sense that you do this as a function of the same numbers that you're dealing with, right? Like this wouldn't be a scenario where it's like, all right, I crunched all these numbers. The market moves about 45 cents. Those are the boundaries. So when it moves down 45 cents, I'm looking to buy. And then my gut tells me like, I'll take it off for like $1.50 winner. Like that wouldn't make any sense. That makes no sense at all. If the market moves about 45 cents, I'm looking to get in when it's down that amount, then I'm going to manage as a function of that. Like the simplest way, Tony, is to be like, I'll take 50% of that. So for instance, here today, you've got a market that essentially, let's say that it opened today at 17. It's down 50 cents. It's down to 16.50. I get in there at 16.50. That's a 1 standard deviation, about 50 cents out. Now I'm going to manage for a loss or a profit at half of that around my entry point, 25 cents. So goes from 17 down to 16.50. I get in. I'm looking to take this off for a winner at 16.75. But if it goes through me down to 16.25, I'm taking this off for a loser because by the law of large numbers, Tony, and I don't want to get too statistical, go too deep here, tell me when to stop, but you have to, when you have the odds in your favor, when you've created an edge in a trade like mean reversion in a market that does mean revert, and it's like, man, okay, I've created an edge of going from 50-50 to 55-45, or in this case, theoretically 68-32, I can't be taking huge losers or holding on to positions for $100, $200, $300 in losses if I'm taking $30 on every winner. So you have to keep that symmetrical as you increase your number of occurrences there. That's just the law of large numbers. And that's what we would have been doing. I mean, like every single night, you can't go into trading being like, oh man, I got all these positions from yesterday that are a real big pain in the butt. You wouldn't get anything done that night. So day trading, these short-term strategies have to be exactly that. And those mechanics are almost always a function of what got you into the market to begin with, the standard deviation. So usually just looking at 50% of that is a good starting place.
Okay, so let's just go through some real numbers, right? We opened here, the SY10 is down about 44 basis points. So I would look to take profit at about half of that, as you said, about 20 basis points. So if I buy at 1646, a reasonable take profit would be around 1666, and a reasonable stop loss would be around 1626, giving me effectively $20 in potential profits if it gets to my take profit, and a loss of roughly $20 if it hits my stop loss. So a 1-to-1 risk to reward ratio, but as you said, because of the mean reverting properties of we would expect that more often we would see a move towards that take profit than a continuation down to the stop loss. That's the theory behind this trade.
It's exactly right, friend. You got all of it there.
So I think that's pretty straightforward. If anyone has any questions, please feel free to type more questions into the Q&A section. But this is also recorded for you so that you can take the time and review this. But again, the idea is that you want to wait for moves beyond the standard deviation. And for those of you that are technical traders, you might be more familiar with a trading strategy called Bollinger Bands, right? Bollinger Bands are the 2 standard deviation move. And a lot of investors look for a stock to exceed the Bollinger Band and look for that mean reverting property. This is a similar type trade, but what we're using is a historical standard deviation, which is about 45 basis points. Once you exceed that, you're looking for either a long if it's down by more than 45 basis points, or if it's more up by more than 45 basis points, you're looking for a contraction back of about half the move that you've seen for that day. So not only are we able to look at this from a yield term perspective, right? And this is something that you can trade, because you can trade the yields directly, the 2, 10, and 30 year. All of these are suitable. All of these are products that you can trade. And we'll talk a little bit about how you can get access to these specific numbers, the standard deviation numbers for each product. When you subscribe to the small exchange, we'll show you how to do that. But these are the numbers as of this week. If the 30 year exceeds 41 cents, you want to short it in terms of a gain. If it declines by more than 41 cents, you want to go long using this type of strategy. So next, what I want to talk a little bit about is that you don't necessarily have to trade the interest rates themselves. You can trade the spread between the interest rates, because there's what we call the yield curve. And many of you that have followed me for a while, you've heard me talk a little bit about the steepening of the rate curve, the substantial steepening of the rate curve we've seen over the past 6 months or so. And that's led to a fairly strong rally here in terms of the financials. And Frank, that's really the only way equity investors can trade steepening and flattening of the rate curve, is effectively going long or short the banks, which obviously is not a very strongly correlated trade. It's a loosely correlated trade. But when we're talking about the small futures, you can actually trade the steepening and the flattening of the curve themselves. Now, I don't want to get too down into the weeds of steepeners and flatteners, because I do think that could be a little bit complex. Let's talk a little bit about a spread mean reverting strategy as well, because you don't necessarily have to understand steepenings and flatteners, but you can still trade the same mean reverting strategy we're talking about across the curve itself. So why don't you talk a little bit about that strategy as you referred to the knob strategy?
Yeah, absolutely. And I know Tiffany out there is getting very excited about this, because she was in there in the chat saying, man, the spread talk is confusing. And I will agree. It is confusing the first time that you hear about it, but hopefully we can get you feeling a little bit better about it. And then from there, it will still, it's like learning options for the first time, or learning anything else. It's like you rarely read something and then immediately you're like, all right, I'm ready to go. But if you do look at it in your trading platform, or maybe play back our talk here today once or twice, it's like, oh, I'm starting to get the hang of it. At the most broad level, Tiffany and everyone else, when you're looking at spreading 2 things off against each other, you're essentially saying, all right, these 2 things are very similar and they are now diverging or they're converging, and I'm looking at a trade between them. Now, as Tony talked about, in the yield curve, it's honestly, in my opinion, probably the most classic place to be looking at spreads. You've got steepening and flattening, which just simply means when things are steepening, that means that interest rates are getting separated from each other. That 10-year is either getting higher than that 2-year or everything else. The difference is simply expanding. That's steepening. When it's flattening, it kind of makes sense that it's named that, because those interest rates are coming down to flat. They're coming down to the same value. Like when interest rates are low, they tend to be flat because everything tends to be around 0%. Anyways, with all of that put aside, when you're looking at spread mean reversion, you're simply looking at what we kind of just talked about, which is like, oh, wow, this market is down a lot, and I might look at buying it, or this market is up a lot, and I might look at selling it. You're just attributing that to the difference between these very similar markets. So the knob spread is the 10 and the 30 year. Now, when you get days where interest rates are up a lot or they're down a lot, you're going to see these fluctuations between the two. And so if you see, today's actually a pretty decent example, you saw the 10-year down about 4.5 basis points or 45 cents. And you saw that 30-year only down about 2.5 basis points or 25 cents. You might look at buying the cheaper one and selling the more expensive one for a mean reversion between the two. And in that scenario, you no longer have a bias to where interest rates on the whole are going. All you care about is that those two fall in line. And this was my bread and butter at the Chicago Board of Trade. It was trading the differences between these things and those mean reverting themselves, as opposed to just buying and selling the outrights. A great trade in its own right, but we were going even deeper with this in the spread trading. And so it's the same as the way you think about anything. Like when you go to fill up your car with oil, it's like the ability to be like, oh, BP is really expensive, Exxon is 10 cents cheaper. It's almost like, wow, I could buy Exxon and sell BP and trade those two prices coming together. That is the same scenario with mean reversion in the interest rate spreads.
Right. So just to reiterate that and kind of express it in my terms, right? Because we usually think of the yield, we usually think of interest rates as a single product, but it's not. It's actually a whole range of products because you have a whole series of different bond prices. But in theory, what happens is that when interest rates rise, the entire curve rises. The 1 year rises, the 2 year rises, the 3 year, the 5 year, they all rise. But what you're saying is that different interest rates will tend, at least intraday, tend to rise at different rates. And sometimes you see where one yield rises just a little bit more than the other one. So maybe the 2 year rises only 5 basis points, but the 10 year rises 10 basis points. And you're looking at the difference, right? So as you say, two gas stations on the opposite corner of the street, once one raises prices by 10 cents, but the other one only raises by 5 cents, you're basically thinking that sometime down the future, that's going to come back and normalize. And that's exactly what you're trading here, is that when one interest rate moves too much versus the other, that's going to come back down, where this might come back down another few basis points, right?
Yep.
And then this one will rise a few more basis points until effectively the equilibrium, it reaches that equilibrium. So that's the concept behind trading these spreads. And again, seemingly complex, but it may not be as complex as you might think. So one of the ways that you can trade that is through the pairs trade using Tastyworks. Mm-hmm. Where you, depending on whether the spread has moved substantially higher or lower, that's where you can go long the 2 year or short the 10 year. And the great thing about, again, the interest rate products is that you can trade 1 for 1, right? You don't have to figure out how many contracts of the 10 year do I need to buy versus the 2 year. You just trade 1 to 1. So let's take a look at what the changes have been for today. So we've had a pretty big move here today of the 2 year versus the 10 year. Is that correct? I just want to make sure I have my numbers correct.
Yeah, absolutely. And you can tell that, with the chart, or you can tell that with the simple idea of like that 10 year is down 40 cents, the 2 years down only 10 cents. And so, yeah, honestly, what we're seeing today is mean reversion coming off of yesterday, where the 10 year was greatly outperforming the 2 year. You could have looked at selling that 10 year, buying the 2 year, and you would have made some profits here today. It's really simple because these products are the same size. And all you're looking at is just like the difference between the two. You can very quickly tell who's outperforming and who's underperforming. And this is extremely relevant, Tony, on days when there are non-farm payrolls, when there are Fed speeches, or there's an FOMC meeting, because that's when you see like, oh, wow, interest rates are really up or they're really down. And intraday, it's like, oh, interest rates are really up, for example, they're up by a lot. But the 10 year just moved a ton higher than the 30 year. And then at some point later in the day, when the smoke clears, so to speak, they usually kind of come back in line. I mean, that was the trade at the Board of Trade, was trading these things off of each other on those big event days. Those spreads would widen out. We talk about it like the rubber band effect. That rubber band would widen out and then at some point, hopefully constrict. Of course, every once in a while that rubber band breaks, but you have to be mechanical and just take your winners with your losers there in a mechanical fashion. But you nailed it here. The pairs trader is a great feature.
So let's talk a little bit about that. As you said, the 10-year yield is down 4 basis points. The 2-year yield is only down 0.8 of a basis point, right? So the differential there is about 3.2 basis points. And I think the metric that you told me was that as long as that spread increases by about half of the standard deviation that, for example, because our standard deviation here is about 4.5 basis points. When we're talking about spreads, because we're talking about between the two, we're only looking at half of that, correct? So we're looking at about 2.2 basis points or so. If the spread between two products move by more than half of the standard deviation, that is an opportunity to trade the pair. So at this point, we're saying that, sorry, go ahead.
No, that's exactly right. Yeah, that's like a back of the envelope calculation that we would usually do is like if the outright moves X, then the spread we're usually looking at like half of X. So yeah, half of that 40 cents would be about 20 cents in difference. And hey, you got that here today. You got 30 cents of difference.
Right. So we're typically looking for anything that exceeds 2.2 basis points. Today, we have about a 3.2 basis point. So this is a potentially opportunity to go long the 2-year and short the 10-year.
Well, actually, I would flip that here today because you essentially want to be looking at buying the thing that's underperforming and selling the guy that's outperforming here for that convergence there. I know it gets a little complicated with stuff being in the red. And yeah, I think you can, yeah, there you go. It's as simple as that. So you're buying the one that's down 40 cents. You're selling the one that's down only 8 cents, hoping for those to come back in line.
Right. Sorry. So that makes perfectly sense. So the 10-year, let's just clarify, the 10-year is down 40 basis points. The 2-year is only down 8 basis points. So what we're basically saying is that the 2-year is going to go drop a little further, and the 10-year is going to increase for these two to come back in line with each other.
Absolutely right. But what's beautiful about this is it could also happen in the opposite manner where the 2-year could actually rise, but as long as that 10-year rises more, it works that way too. Like this is what's the beautiful thing about pairs trading and spread trading is I no longer care if interest rates go higher or lower. I just hope that the difference between the two converges. It's a really nice thing to add to your toolbox.
Right. So, and just to kind of put it in that gasoline terms, right? If I'm short BP and long Exxon, it doesn't matter whether the gasoline prices go up $1 or down $1. I don't have exposure to the pure gasoline prices. I just have the exposure to the difference between BP pricing and Exxon pricing across the street from each other. So in this particular case, I hope this makes sense because the 10 years down 40 basis points, the 2 years down only 8 basis points. My expectation is that the 2-year will actually decline a little bit more and the 10-year will actually rise a little bit more. And I can trade that by going long directly the 10-year and short the 2-year. That's just how easy these interest rate futures have made this particular trade. So, and as you can see, my order has just been filled right there by trading that pair using Tastyworks. And so let's talk a little bit about that, right? So because we had a 32 basis point move today, would I have a stop loss at effectively half of that at 16 basis points? Okay,
that's exactly right.
So I'd have a take profit at 16 basis points and I'd have a stop loss at also 16 basis points because of the current move today of about 32 basis points.
Yep, absolutely nailed it. All these things starting to hopefully make a little bit more sense as the mechanics kind of lend to just these different strategies. It's funny how many permutations of things you can look at just given 3 new markets here.
Right. So that, you know, like I said, this is even a new strategy to me, right? And I think that it's a new strategy to me because prior to the small futures, I couldn't trade this using treasury futures. It would just be too complex for me to do, and I certainly wouldn't try to do that. But so I'm really glad that we got to cover that. But I do want to have one last discussion around, instead, for those of you perhaps maybe you're not into intraday scalping, maybe you're not comfortable sitting in front of your screens trading these types of products, but you have a longer term view in interest rates. Another way that you can take a longer term view is directly through the interest rate futures themselves. So Frank, let's talk a little bit about just what is the longer term strategy with respect to interest rates.
This is amazing, because what we just did was essentially like the hardest part. And now we're going to conclude here in the interest rate space in something that's going to make a lot of sense to everybody out there. If you were able to hang with us in that, this is going to be a lot simpler. And if you weren't, then we're going to hopefully end at a place that's still actionable in the interest rate space. So at the end of the day, we went from day trading to spread trading, all this mean reversion stuff. I want to just take a step back and look at the interest rate landscape right now, look at what's happened, and look at what potential opportunities are there in the medium to long-term future. So what you've seen is essentially mean reversion in the long term for that 10-year this year. Now, the average 10-year interest rate going back 4 decades is around 3%. We saw the 10-year interest rate last year as low as 0.5%. A lot of people thinking, oh, we're going to negative. This is going to be some, crazy apocalyptic trading environment. And that didn't happen, needless to say. We've seen interest rates climb from 0.5% in the 10-year to where they rest right now, about 1.6, 1.7%. Now, what's intriguing to me is we're seeing that long-term mean reversion occur in that market. Still some room to the upside here for that market if you were looking for that long-term long in there. But what's really intriguing, and a lot of people have liked looking at, is that 2-year, which we've seen stay glued to 0% here. But that one has a long-term average of 2% as well. I mean, not as high as the 3% in the 10-year, but still pretty significant. Hasn't moved with nearly as much upside. There could be a long-term play there in longing that 2-year for the next few years. The trade really becomes, Tony, if I buy this 2-year rate at 0.16% or $1.60 in the S2Y futures, then the risk is negative interest rates, negative territory, 0 or below. But the upside, I feel, is asymmetric at this point, given the fact that the long-term average for short-term rates is 2%, and we're still glued to 0. So the trade becomes do you think we're going to revert to normal in that 2-year rate, or do you think we're going to fall down to negative values we've never seen before? Of course, you make that decision for yourself, but a really intriguing long-term trade in the S2Y product, a one that a lot of people have liked looking at. And what's really nice is that the margin for this is just around $60. This is a product that's $160, really small and fit for the everyday trader.
So the trade here for long term is actually quite simple, right? You're basically going long the interest rate if it's below the long term average, and you're going short the interest rate if you're above the long term average. And right now, both the 10-year and 2-year fairly substantially below those long term averages. So as a long term investor, you could effectively take a simple long position in both of these products. And just to put that into perspective, the 2-year currently trading at 140, effectively $1.48, would have to reach $20 in order for it to reach that long-term average.
Yeah, absolutely. I mean, this is one that comes along very seldom, where you've got a serious price extreme. I mean, it's remember when VIX got as low as $7, $8, and it sat there for a little bit, that's for sure. But I mean, you'd be hard pressed to find that for a sustained amount of time. And then quickly we got above that average, and now we're circling that average in VIX of 16 to $20. Same with S2Y. You could hang around 0 for a while, but we've never gone below 0. And that upside is asymmetrical, a lot more than the historical case for downside in that product.
Well, I think that this is a really good conclusion to what has been, I think, a very educational session, not only for, I think, our viewers, but also for myself. But I do want to wrap up with one thing that does come to mind from my perspective, because the strategies that we talked about today are what we would consider intraday scalping strategies, meaning you're placing quite a few trades if you're trading these types of products. Now, first of all, the cost for trading small futures is relatively inexpensive, 25 cents a contract, if I'm not mistaken, at the small exchange. Now, many of you have already seen quite a few of these sessions where I've done this with Tom, I've done this with Pete from the small exchange, and Frank, thank you so much for joining me today. But as you start thinking about these products and you start thinking about perhaps if you're going to trade them actively, you can subscribe to a one-time subscription for just $100. It's a lifetime subscription, right? It's not $100 a month, it's just $100 a one-time payment, and it gives you a 50% reduction in the commissions on trading these products. So if you do trade these products actively, you can save quite a bit of money from trading these products by becoming a subscriber.
Yeah, absolutely. And that comes along with, the 50% discounted fees is like the first thing there. Like, we want you to save every time you trade the products so that you can easily trade them as many times and employ all these strategies without them affecting your P&L at the end of the month or years down the line. But also, we are giving out those standard deviations and a ton of other data to subscribers in what has now become a data-packed newsletter to them every Monday morning to get all of the information around the different small exchange products and everything else to get going there. Yeah, you see a little preview of it on the page. They also are getting, reduced fees on all of our new products that we add. We actually just added, Tony, and maybe we can conclude here, just added a small crude oil product. You're going to get reduced fees on every single thing we add there. And all of these products are coming out pretty much on a monthly basis, reduced fees and added data and market context specifically for those subscribers. And yeah, here's that SMO product just added to the small exchange, the small crude oil futures at the exchange. We're super excited about it. We're adding, stuff like cannabis and everything else down the line, and they'll get those exclusively low fees for our subscribers, the people who are part of our community there. So a great offer, we think. And yeah, it's that one-time payment. You join us for life. You get those reduced fees and exclusive content for as long as you're trading the smalls, man. It's good. It's a great one.
Yeah, and I will be doing a session, I believe, on July 1st with Michael Coe, who was a ex-oil futures trader on the NYMEX. So we will be covering that here on July 1st. So we've actually done quite a few of these products, right? We've talked about precious metals, we've talked about interest rates, we've talked about pretty much all of the products, but the new listing with the oil contracts is brand new, so I will be talking about that here on July 1st. And just to iterate, for those of you that asked the question, where can you trade these small futures? Currently, one of those brokers that supports this is the small exchange. Is Tastyworks. And if you want to open up a Tastyworks account, you can do so using the link here on your screen, which I just posted into the chat window, so that you can open up an account at Tastyworks to trade these products that Frank and I have just spoken about. Whether you're trading the interest rate products, precious metals, dollar. I've traded the dollar products, I've traded the interest rate products, the precious metal products, and I will likely take a look at those oil products in the next few days. With that, Frank, I just want to say a big thank you for your time here today, because I have learned a lot in terms of how I can trade these products. I never thought of interest rates as something that I can trade short term, and I've learned a lot in terms of how I can scalp these products. And I think this is something I'm going to start trading myself.
Thanks so much for having me, Tony. Yeah, we're super excited about this product here, and we're excited about everything that we're looking to add down the line. And I'm excited personally to see that talk concerning small crude oil. That'll be a good one. But yeah, hopefully people at least learn today about how they can access simply that interest rate. I'm looking at news stories of 1.7% in the 10-year yield, you go right to S10Y. It's priced at $17. You buy it, you think it's going higher, you sell it, you think it's going lower. And then we added a whole bunch of strategies around that. So glad to be here, man. It's always a blast hanging out with you. This was a lot of fun. Let's do it again sometime.
It absolutely is. Actually, Frank, if you don't mind, let's just answer a couple of questions that are still
Yeah.
outstanding here. Timothy is asking if you have a recommended account size to trade these small futures contracts.
Yeah, absolutely. That's a great question. And what's really nice about the small exchange products is we try to create them in a way that the margins, which are dynamic given the efficient nature of futures margining, it really gauges how much the product moves, and then it asks you to put up how much that thing moves. All of our margins are between $50 and about $500, $600. The interest rate ones are actually on the low side. That 2-year, just $60 in margin. The 10-year, about $220, 30-year, just over $300. With that being said, you usually want to have an account that can withstand, movement in that product and then some. So like if I'm trading a product that has a margin of $200, like our small treasury yield products, then I would want an account of at least $2,000, $3,000 to be trading in there so I can comfortably take that amount of risk. Now, like we talked about, the market moves about 45 cents or $45 on a daily basis, but that's usually a nice round number that I look at. Like, what's the margin on the product? And then 10 to 20 times that is what I want in an account size to be trading that thing, which is hard to come by in other futures. I mean, that crude oil market, a margin that's in the thousands there, or the E-mini S&Ps, even the micro E-mini S&Ps, thousands of dollars in margin. You're going to want to have an account that's 10 grand, 20 grand, 30 grand to be trading. So bringing things down to a smaller size so you don't have to be that big of an account holder to be trading the smalls.
Great. Thank you so much for that. There was one question here about, what does a 46-cent move in the 10-year correlate to? Just to be clear, when we're talking about 46 cents, that's 4.6 basis points, because each cent is a tenth of a basis point. So when you have a 46-cent move, that equates to 4.6 basis points, not 46 basis points, just to be clear.
Yeah, absolutely. I think that we chunked that a little bit amid all of the math that we were doing back there. But yeah, you're exactly right. Like right now at 1643, that's a 1.643% rate. And so, yeah, you nailed it with the 10 cents is 1 basis point, if that's simpler for people.
Yeah. The other question is, how do you calculate the risk or downside? And this is really what I think is really easy from that perspective, because it's the same as an ETF position with 100 shares. So you can think of this as a stock that's currently trading at $16.46, and you're buying them in 100 share increments. Each contract is effectively the same as buying 100 shares. So if you bought a stock at $16.50, and it rises to, let's say, $17, you would make $50 on that trade, because a 50-cent move times by 100 multiplier would be a $50 move. So, but if it moved down to, let's say, $16, right, you would lose $50. So it's a really easy symmetrical way to calculate potential risk and potential reward, because it's just like trading an ETF or a stock with 100 shares.
That's exactly right.
I think I've already gone over a paper trade here. Any spread trades? I think we've talked about that. Are the main contracts March, June, September, and December? So no, there's basically 2 monthly contracts that are listed, which are the 2 next month, the 2 front months, correct?
Yeah, so we wanted to create hopefully a simpler setup here, because there are treasuries and equity index futures. They do March, June, Sep, Dece. We've got crude oil futures that traditionally do every month of the year, ag futures and silver futures and gold, all different expirations. We just said, forget about it. Let's bring all of these to monthly expirations. The active one is just the next month's expiration right now. That's June, because we are in the end of May here. And once that June contract is up on the third Friday, you're going to be shifting into July. And so, yeah, every single month for every product. That way you just have to kind of look up at your own calendar and be like, what month is it? All right, that's the one that I'm trading here, and not have to deal with trading, June silver and September equity index futures and like all that crazy stuff that gets out of whack in the futures world.
Right. And we got a lot of Canadian viewers here. I know a lot of viewers waiting for Tastyworks to come to Canada. So my understanding is that right now you would have to wait until Tastyworks opens Tastyworks Canada before you can trade these products from Canada. But I do believe you can trade them through your IB account for those of you that are at Interactive Brokers.
Exactly right. Yep.
Okay. Well, Frank, thank you so much for your time here today. I really appreciate it. I've learned so much, and I hope everyone here that's viewing this session has learned as well. We will, this session is recorded, so we'll not only send you the slides as well as a recording so that you can follow along at your own pace, go back, look at the scalping strategies that Frank and I talked about, look at the numbers again, and chances are the numbers won't be as confusing once you go through it again, because they are actually quite straightforward.
Absolutely right, Tony. Thanks so much for having me, man.
Thank you for joining us. Thank you so much. And I hope you guys have a great afternoon, and I'll see you guys here next week on our next Market Outlook session. Thank you so much and have a great night.